Quick disclaimer before we start. This video is for education only. It is not investment advice. Trading options in F&O carries a real risk of losing your capital. Everything here is my own personal process. Always do your own research before you take any trade. You opened the Nifty options chain, 24200 CE, 24200 PE. You clicked PE. Nifty went up 200 points. You lost rupees 2000. That is what happens when you don't know CE from PE. CE is call option. Buy CE when you think price goes up. PE is put option. Buy PE when you think price goes down. Think of it like a bet direction. CE is north. PE is south. One letter tells you your entire trade direction. Nifty at 24200. You think it hits 24500 this week. You buy the 24200 CE at rupees 120 premium. Lot size 65. Total cost 65 times 120 equals rupees 7800. Nifty closes at 24500. CE worth rupees 300. Profit rupees 180 times 65 equals rupees 11700 on rupees 7800 invested. In the 3 p.m. scan, step 1 identifies the strongest or weakest stock. That answer, bullish or bearish, tells me CE or PE before I open the options chain. Everything else follows from that one decision. Nifty moved up 250 points. Your CE barely moved. It actually lost value by expiry. Direction was perfect. P and L was red. That is wrong strike selection. Strike price is the level your option bets the stock will cross. Your profit starts above the strike plus the premium you paid. That is your break even. Choose a strike too far away and you need a massive move just to reach zero. Nifty at 24850. You buy the twin 5200 CE at rupees 45. 2 strikes OTM. Lot size 65. Cost rupees 2925. Break even 25200 plus 45 equals 25245. Nifty closes at 25100, up 250 points. Still 145 points short of break even. Option expires worthless. Rupees 925 gone. 3 p.m. scan rule. First 2 weeks of the month buy ATM or maximum 1 strike away. Last 2 weeks ATM only. This rule exists so your break even stays within the realistic range of movement. You bought a Nifty 25,000 CE. It went 200 points in your favor. Then expiry arrived 2 days later. The option expired worthless. You stared at the screen. That is what expiry does when you ignore it. Expiry is the date your option contract ends. After that date, settlement. You receive intrinsic value or zero. Every day that passes, your option loses time value, even if the stock does not move. This is theta decay. It accelerates in the final 48 hours. Nifty weekly expiry every Tuesday. Buy a Tuesday expiry on Friday at rupees 120. 4 days of time value included. Same option on Monday evening at rupees 120. Rupees 55 by Tuesday morning, even if Nifty has not moved at all. The clock is destroying value overnight. 3 p.m. scan rule. Only trade options with at least 3 to 5 days to expiry. Never trade on expiry day itself. Tuesday afternoon Nifty trades are a trap. Theta destroys the option value in the final hours faster than any price move can recover it. You bought a Nifty 24600 CE for rupees 18. Nifty moved up 300 points. Your CE barely moved. You were deep OTM and did not know it. That rupees 18 option needed Nifty to move 418 points just to break even. ATM. Add the money. Now it is the strike closest to the current price. ITM. In the money. The CE strike is already below current price. Real intrinsic value today. OTM. Out of the money. CE strike is above current price. No intrinsic value. Only the hope of a large move. Nifty at 24200. ATM CE equals 24200, priced rupees 120. One strike OTM equals 24300 CE, rupees 75. Deep OTM equals 24600 CE, rupees 18. Lot size 65. The rupees 18 option needs Nifty at 246 on 18 to break even. F4 or 18 point move. Low probability, full capital risk. 3 p.m. scan rule. Always buy ATM or maximum 1 strike OTM. Never deep OTM chasing cheap premiums. The probability is already priced in. Cheap means unlikely. That rupees 18 strike exists because the market thinks it will not get there. Infosys results day. Beat expectations. Stock up 3%. Your 1500 CE was worth rupees 80 before results. You opened Kite after the announcement. It showed rupees 55. Direction right. Option down rupees 25. That is premium. Specifically IV Crush. Premium has 2 parts. Intrinsic value, what the option is already worth right now. Time value, what you are paying for the possibility of more movement before expiry. Events inflate time value. The moment the event passes, time value collapses. Options are priced on uncertainty. Remove the uncertainty, remove the value. Infosys at rupees 1500. 1500 CE at rupees 80 before results. Intrinsic value 0. Time value rupees 80. Pure expectation. Results come. Stock hits rupees 1545. Intrinsic value rupees 45. But time value crashes from rupees 80 to rupees 10. Event is over. Total option value rupees 55. You paid rupees 80, lost rupees 25 on a correct call. Step 3 in the 3 p.m. scan. Check IVP before you trade. IVP above 80. Options are expensive. Use a spread to reduce premium paid. IVP below 20. Options are cheap. Naked buy makes sense. One number tells you whether premium is fair or inflated.
You saw Tata Steel options at rupees 8. You typed in quantity 10. Order rejected. Minimum 2750 units. Your rupees 80 trade just became rupees 22,000. Your account did not have that margin. That is lot size hitting you in real time. Lot size is the minimum number of units in one option contract. You cannot buy half a lot. The exchange sets this number for every stock and index. It is the multiplier that converts your per unit premium into actual capital required. NIFTY lot size 65 units. NIFTY 24200 CE at rupees 120. One lot cost 65 times 120 equals rupees 7,800. Tata Steel lot size 2750 units. Tata Steel option at rupees 8. One lot cost 2750 times 8 equals rupees 22,000. Same rupees 8 price. 3 times more capital. Lot size changes everything. Step 6 in the 3 p.m. scan. Maximum 20% of capital per trade. Rupees 50,000 capital means rupees 10,000 per trade maximum. At Nifty lot cost of rupees 7,800, that is exactly one lot. This rule exists, so one bad trade cannot end your account.
Stock moving up strongly, volume high, you bought the CE. Stock kept climbing, your CE lost value, OI was falling. Smart money was closing positions, not entering new ones. The move had no conviction behind it. Open interest is total outstanding option contracts not yet closed or settled. Rising OI means new money entering. Conviction behind the move. Falling OI means positions closing. The move has no new participants. Price alone tells you direction. OI tells you whether to trust it. 4 combinations. Price up, OI up, long build up, new buyers entering, bullish, price up, OI down, short covering, sellers exiting, weekly bullish, price down, OI up, short build up, new sellers entering, bearish, price down, OI down, long unwinding, buyers hitting stop losses are bearish. Step 2 in the 3 p.m. scan, direction confirmation via OI. CE trade needs long build up, PE trade needs short build up, OI falling on a moving stock, skip. There is no institutional conviction behind the move, and without conviction, the move reverses.
PCR was 1.05. One trader said bullish, another said bearish. Same number. Both used it differently. The number alone told them nothing. What matters is where the OI is sitting, not the total ratio. PCR is put call ratio. Total put OI divided by total call OI. Above 1.2 means put dominance, fear in the market, bearish signal. Below 0.7 means call dominance, confidence, bullish signal. But institutions mostly write options, not buy them. High put OI at a specific strike can mean writers sold puts expecting support, not buyers panicking. Nifty at 224200, PCR equals 1.05, looks neutral, but 224500 strike has 14.2 million call contracts open. A ceiling, writers betting Nifty stays below 224500. 224200 and 223500 strikes both have over 10 million put contracts. Floors, writers expecting support. The chain says range bound 23500 to 24500. The number 1.05 missed all of that. Step 2 in the 3 p.m. scan. PCR above 1.2. Bears dominant. Below 0.7. Bulls dominant. And I check where maximum call OI and put OI strikes sit relative to current price. That shows me the ceiling and floor that could block my trade's target before expiry. You bought a C, structure correct, direction correct, but you paid too much for the option. Results came out, stock moved your way, but IV collapsed and erased your profit. IVP would have warned you before you entered. IV is implied volatility, the market's expectation of how much the stock will move. High IV means options are expensive. IVP is IV percentile, where current IV sits compared to the last 52 weeks. IVP of 80 means IV is higher than 80% of all days this year. Options are very expensive today. Tata Steel pre-earnings, IVP at 85. You buy a naked CE at rupees 80. Results positive. Stock up 2%, but IV crashes from 45 to 20. CE drops to rupees 35. You paid rupees 80. Lost rupees 45 on a correct trade. Lot size 65. That is rupees 2,925 lost on a winning direction. Step 3 in the 3 p.m. scan, IVP below 20 equals naked buy. IVP 20 to 80 equals debit spread. IVP above 80 equals credit spread. One number changes your entire position structure. IVP 85 pre-earnings is not a buy signal, it is a spread signal.
3:22 p.m. Your C is up 15%, you are watching it. Kite auto squares your position at 3%, you had selected MIS. You did not know it auto closes before 3:30 p.m. That one drop down cost you 12%. MIS is margin intraday square off. Your broker automatically closes the position before 3:30 p.m. if you do not. Same day trades only. NRML is normal. You can hold overnight for multiple days until expiry if needed. MS is a day pass. NRML is a season ticket. 3 p.m. signal at 2:45 p.m. You enter Nifty 24200 CE at rupees 120. Lot size 65. Cost rupees 7,800. Next morning Nifty gaps up 150 points CE at rupees 180. Profit rupees 60 times 65 equals rupees 3,900. In Miss Kite closed you at 3:28 p.m. the previous day at rupees 122. Profit rupees 130. Same trade, different product type. Rupees 3,770 difference. Step 5 in the 3 p.m. scan. Always NRML, never MS. The 3 p.m. system is designed for 2 to 3 day holds. MS destroys that edge by forcing an exit 45 minutes after entry. I made this mistake exactly once. Check the product type drop down every single time before you hit buy. You hear a trader say, I'm short Nifty. You think he sold Nifty stock. Wrong. He bought a put option. In F&O, long and short describe your position, not your direction in the stock. Long means you are the buyer. You paid the premium. You have the right to exercise. Your maximum loss is the premium you paid. Short means you are the seller, also called the writer. You collected premium. You have an obligation if the buyer exercises. Your risk can be significant on the wrong move. In F&O language, long CE means you bought a call, you are bullish. Long PE means you bought a put, you are bearish. Short CE means you sold a call, you expect the stock to stay flat or fall. Short PE means you sold a put, you expect support to hold. The 3 p.m. scan is designed for long trades only. We buy options. We never sell them. So when I say CE trade in the 3 p.m. system, I mean long CE. PE trade means long PE. Your maximum loss is always the premium paid, known before you enter. That is why the 3 p.m. system only goes long. That is your F&O vocabulary sorted. If this made options clearer, subscribe to the 3 p.m. Trader. I break down one trade and one concept every day, straight from the 3 p.m. scan. Trade smart, manage your risk, and I will see you in the next one.